Time is ticking on the December 31 deadline for this year's tax situation. Today, we're going through 7 tax moves you need to consider so your April tax situation is a positive surprise. Welcome to Retire Today. I'm your host, Jeremy Keil, and we're here to help you create your dream retirement. Today, we're talking about the actions you need to consider before the tax year is over on December 31. We've got 3 weeks left. The holidays are approaching, and while you might be busy and most people push off different financial tasks until it's too late, don't let that happen to you. December 31 is a deadline for this tax year for the majority. Maybe we'll talk about some things that get pushed. You do have a little bit of room there, but you don't want to miss out on the deductions, especially in a year like 2025, where there is new tax laws in a year, as of now, recording this early December, where the stock market is near all-time highs. So let's go through the 7 areas for your year-end 2025 to consider. Make sure that you take control of what you can control. Now, here's why 2025 is such a critical year. The results for the stock market, the bond market, at least through the early December point of time, are up. Your high returns in the market might mean you've got a imbalance between what you thought you had and what you wanted to have. I've got in my book here. Let me pull out the chart. So the Retire Today book, page 111, I've got a chart about rebalancing. That's something you ought to consider. We'll talk about where if you had 60% in the stock market and $1 million on January 1 of 2020, 2 years later on January 1 of 2022, your 60% stock market, this is a S&P 500, grew to 68%. That's more risk than you signed up for. With the stock market near all-time highs, rebalancing is something you want to consider. But there's also these new retirement contribution limits for 25 and 26, some different things with the new laws, even some laws a bit ago that talk about your catch-up contributions to your 401k. You can do that starting in 2026 still. That's not changing. But for a lot of people, it'll have to be a Roth contribution rule. Now, there's also the RMD rules, the QCD rules, qualified charitable distributions, that are out there, kind of catch you by surprise because they've changed the numbers a bit over time. It used to be 70.5 a few years back, then it became 72 and 73 for required minimum distributions. In the future, that'll become 75. And of course, there's now the One Big Beautiful Bill Act, OBBBA, and that changed a lot with charitable deductions for 2026, changed some things for this year with deductions, something called the SALT, the state and local tax limit, also changed the standard deductions and things like that. So we're going to go through all these changes, and we're going to talk through these 7 things to consider, the 7 steps to take for your year end. So the first thing I want you to consider is to manage your tax bracket. You've got a lot more control over your tax situation, especially in retirement, than you might have thought. Are you having a higher income year this year? I've got some clients who are retiring this year. Things are paying out like restricted stock units, or perhaps you were even let go or took an early retirement, and they are paying out a high lump sum of money to you as part of that package. There's a lot of people I'm talking to who have a really high tax year here in 2025. And I've asked them, I'm asking you, if that's you in a higher income tax year, consider ways to accelerate your deductions to bring down your taxes. If you're in a higher than expected tax year, you want to try to lower your tax situation. Often that's through giving money through charity, giving money to a donor advised fund, especially when the stock market is near all-time highs. You can gift stocks over to the donor advised fund if you meet the rules. Now, this is related to charity. I'm going to dedicate next week's podcast to talk about specifically ways to lower your taxes when you are giving money to charity. So I won't talk too much about this here, but take a look, project out. That's something I do with my clients every year, is let's project out what this tax year is going to look like, decide if it's a higher income year or a lower income year, and then plan accordingly. So if it's a higher income year, you want to grab those deductions quite often. If it's a lower income year, you often want to accelerate your income. Perhaps you're a business owner and for some reason you've got a lower income year, but you can perhaps put a bonus on your tax return for this year at a lower tax rate. Or you might be able to do a Roth conversion. You might take money out of your accounts just to have it in the bank so that you pay the taxes this year and you spend it next year. That's incredibly important for when you're on the Affordable Care Act. As of now, early December, this could change anytime, but early December here, the Affordable Care Act, the cliff is coming back. I was just looking at it for somebody, and so this is a big deal. You're going to be on Affordable Care Act. You are getting a subsidy right now. Let's see what that subsidy would be for next year. This is a 60-year-old couple, I think 61 and 62, right around there. And the deduction or the premium tax credit that they could get if they're below the level, it's called the 400% of the poverty limit. If they are below there, the tax credit is nearly $30,000. They go over by $1, that's the cliff, they lose it. And so we're helping them to pay taxes now in the lower income year so they have money that is tax-free for next year so it doesn't affect their Affordable Care Act premium. Hi, it's Keil here, and I know you're listening to the Retire Today podcast because you would like to create your dream retirement. I created a free video course to show you just how to do that. Head on over to 5stepretirementplan.com to learn how to create your retirement master plan. That's 5stepretirementplan.com. You can use the number or spell it out. You'll get there either way. Head over to 5stepretirementplan.com. Thanks for listening, and now for the rest of the show. Now, number 2, something you ought to look at every single year is, can you harvest any tax losses? You might say, Jeremy, what are you talking about? Tax losses? You just said the stock market is near all-time highs. Well, you might still have some of your stocks, some of your investments at a lower tax situation. You still want to take a look, find if there's any tax losses, and consider, do you harvest those tax losses? Of course, there's some things on there like wash sale rules. You can't just sell the stock, go buy it back right away within 30 days. But there's also the opposite part of it. What if there's tax gains? I've seen plenty of tax returns in my day where you are in the 0% capital gains area. And if you don't have to worry about things like the Affordable Care Act income rules with a premium tax credit, why would you not want to pay 0% taxes on your stocks and your funds? And what's interesting there, if you're in the 0% bracket, when you sell those gains, you can buy it back right away. There's no 30-day wash sale rules for gains. So you might just want to book the gain, buy it right back right away, and you're just resetting your cost basis up. So look at your tax losses and your tax gains. What I've been seeing a lot this year is tax gains in bond funds. And what's interesting, if you think about bond funds, they generally pay out interest, and those interest rates are showing up over time on your tax return. But if you can have a capital gain in a bond, the long-term capital gains rate on your bond funds is a lower return, is a lower tax situation compared to interest rates that you're receiving on your bond funds. So almost always you want to book a long-term capital gain on your bonds, your bond funds, if you can. Make sure it works into your investments. Make sure it doesn't affect other things, but look at your capital losses, if you have them, and your capital gains. You might want to be booking your capital gains on purpose. Now, capital gains, that's step 3. If you do have mutual funds, I'm seeing this a lot lately. If you have mutual funds, they have capital gain distributions. A lot of your mutual funds record large capital gain distributions in December. You probably didn't get the money out. It probably just sat in your account, but you'll see on the 1099 soon that there was a capital gain distribution. You want to look into that. You can find that through the fund companies. So wherever you have your funds, at T. Rowe Price, Fidelity, the big ones, whoever's American Funds, whoever's out there, they should have a prediction on their website of what are the gains likely to be. Keep an eye on that. And also take a look in your brokerage account in December to see what was recorded on there. Make sure you are well aware. Put that into your tax planning of what is your capital gains, not because you sold it, but because the mutual fund recorded that capital gain in December. You might need to do some tax withholding on that. You might need to do something else because of that, which is step number 4, get your tax withholding right. A lot of people I talk to, they say, I'll just figure this out at the end. It all kind of washes out. And that was maybe true a few years back. You saw a penalty for not getting your tax withholding right, but it wasn't that big of a deal. Well, now interest rates have changed, and the tax penalty that you pay is a lot of times just really an interest rate. It's like the government's charging you interest. They don't give you interest quite often if you pay early, but they'll charge you the interest if you didn't pay your quarterly estimated taxes, if you didn't pay on time. So don't wait until tax time. I'm in Wisconsin. Last I checked, the interest rate they use for not paying your quarterly estimates on time is 12%. 12%. That's too high to ignore. You want to get your tax withholding right. So you take a look at 2025. You project out what your income might look like. You also see what have you done already through tax withholding from your paycheck or your pension or your Social Security or from your IRA distributions, and make that tax withholding payment if you need to. Or if you're over 59 and a half, often you end up taking money out of your IRA and just sending it straight out to the government as a tax journal, tax withholding. We're helping a lot of clients with that right now, where they've earned 3.5% to 4% interest on their money that's in money markets all along the way, and then they're paying their taxes out of their IRA at the end of the year, sending money from your IRA to the IRS, to your state tax places. That counts as a distribution, which means if you're below 59 and a half, there could be a penalty. But if you're over, if you're 73 or over, if you're in the RMD world, that counts as a required minimum distribution. And for whatever reason, the government says if you're paying your quarterly estimated tax payments, you owe that on April 15th for your first quarter, then June 15th, then September 15th, and January 15th. If you don't get it in by those exact times, the clock's ticking. They're charging you interest on that first quarter based on April 15th when you didn't put the money in. But when it comes to withholdings from your IRA, the tax rule, it's December 31. Doesn't matter January 1 or December 31. If it comes from your IRA out to the IRS, out to the tax authorities, they don't charge you any interest. They say you met the rule. December 31 is a deadline, not those quarterly times along the way. So get your tax withholding right. And perhaps if you meet the rules, you're old enough and want to, you can withhold from the IRA so you don't have that bad tax surprise in March and April. You don't have those tax penalties. You want to avoid those underpayment interest penalties. Step number 5, what you want to consider this year, that's for certain ages. If you're 70 and a half, you might want to use the qualified charitable distribution rule. In 2025, you can give up to $108,000 from your IRA over to directly to a charity. Why would you want to do that? Why would you want to do that? Even if you're below 73, I have a new YouTube video out about qualified charitable distributions. We'll put that in the show notes. And that was the first question. The first comment on my video was, why would I bother doing a qualified charitable distribution if I'm 70 and a half, but I'm not forced to take the money out with the RMDs at 73? Well, here's a few reasons that I shared with them. I've got clients that were taking money from their IRA and they're using some for income, but they're also giving money to charity. And when they're 65 years old, when they're 69 years old, 70 years old, that's great. You're taking money out, you're giving it to charity, you're doing what you want. But if you're taking money out from your IRA and then writing the check to charity, you are far better off having that IRA money go directly to the charity. And if you're not yet 73, it's lowering your traditional IRA accounts, which means when you hit 73, your required minimums will be lower. And especially if you're in the standard deduction world for 2025, you're not getting the itemized credits. You still come out ahead doing the qualified charitable distributions, even if you have the chance to itemize most times. I'm going to talk further about the qualified charitable distributions in my next episode next week, where we're diving into charitable giving ideas, tax saving ideas for the end of the year. Step 6, the sixth thing you want to consider for the end of 2025 is making a gift, giving money away to an individual, not charity, but to an individual. In 2025, the maximum annual exclusion gift you can give away is $19,000 per person. And then again in 2026, it's also $19,000 per person. So that's not changing, but it's the end of the year, which is also the beginning of the next year. If you're trying to give away more money over your lifetime, if you're trying to give away a big gift for Christmas or to get it out of your estate, you can use the fact that it's December now and soon it will be January. You don't have to write the $19,000 check. You write the $19,000 check in 2025, you write another $19,000 check in 2026. It essentially doubles how much you can give away. That is the phone call I have next. Is somebody wants to give away a decent amount of money. How are we going to help them to structure their giving between the husband and the wife to the kids with 2025 and 2026 so that they can give away what they want without having to trigger that gift return, that gift tax return? Certainly, if they wanted to give away a significant amount of money, you can give away as much as you want. People ask me all the time, what is the limit for giving away money? The answer is there is no limit. There's no limit for what you can give away. There's just these different levels. No limit, just levels. The level is $19,000 per year, where you don't have to bother with the gift tax return. Above $19,000 per person per year, you want to report that on the gift tax return. And all they're doing is they're checking how much have you given away over your lifetime. In 2025, it's $13.99 million. It's not till you give away $1 more of that you actually start paying the taxes. Again, no limit, but not till you reach about 14 million that you start paying the taxes. And in 2026, that changes to $15 million. And you might be thinking, that's a lot of money. Why would I bother giving away that much money? That's between you, your spouse, your financial advisor, your tax person. But where I see it most is I want to help my grandkids with their 529, their college savings plans. And you can gift, it's called superfunding, a 529. 19,000 times 5 is $95,000 that you could put into the 529 plan. And you can do it one time, and you can do it now. It counts as the next 5 years worth of exclusion gifts. You still don't have to report that. It fits the exclusion. So a lot of times people might want to super fund, kind of pay ahead of time into the 529 for their grandkids. So we've gotten to step 7 here. Let's review the first 6 things you want to consider. Number 1, you want to manage your tax bracket. Project out your tax return. Determine, are you in a higher than expected income year or a lower than expected income year, and then act appropriately. Try to take the deductions or pay the taxes on purpose. Step 2 is to harvest your capital gain losses if you have any, but also harvest your capital gains if you have those too, and it happens to be a good tax year for you to do that. Step 3 is you want to check your mutual fund capital gain distributions. This surprises a lot of people, but you can plan ahead of time by looking on the mutual fund website. What is the capital gain that's going to be paid out most likely in December, and also checking your brokerage account to see what was paid out so far in December. Step 4 is you want to get your tax withholding right. Find out ahead of time, are you likely to owe money to the IRS when it comes to tax time? And you can lower your underpayment penalty by matching the rules with getting the quarterly estimates in on time, or if you're past 59 and a half, taking an IRA distribution to send out to the government. That's called a tax withholding journal. Step 5 is to use QCDs, qualified charitable distributions, if you are 70 and a half or older, as a way to still get money to charity, but often lower your tax return. Step 6 is making the annual exclusion gift, which is $19,000 per person in 2025. Doesn't change for 2026. That's $19,000. If you want to do your giving, take advantage of the 2 different tax years that are showing up very shortly. 3 weeks and a day away, you might be in a new tax year, and you can split your gifts over your tax year, which brings us to step 7. The 7th thing you want to consider at your year-end planning is what I mentioned at the beginning of this episode, where the stock market is near all-time highs, at least as of this recording date early in December, which means your risk is likely different than what you wanted it to be. In my book, Retire Today, I've got a chart, page 111, that talks about this, Retire Today, where the risk you sign up for quickly changes. And if the market moves enough and you wait long enough without making a change, without rebalancing it, you'll have the wrong risk. You'll have the risk that is higher or lower than you signed up for. Now, rebalancing your portfolio, your investments, is just part of your planning. It's part of your year-end planning. If you're trying to retire right now, if you're trying to retire in the next year, I'd encourage you to check out my book. It's Retire Today, where I talk about that one area of investments and rebalancing, along with all the other areas. There's 5 areas, 5 simple steps to go through to create your retirement master plan. You can buy my book, Retire Today, at jeremykeil.com. That's JEREMYKEIL.com. Thank you for listening to the Retire Today podcast. We believe if you know more about your money, you will feel better about your money and you will make better money decisions. Hi, I'm Jeremy Keil. If you'd like to learn how my team can help you get more income, pay less in taxes, and avoid big retirement mistakes, head on over to keilfp.com. That's KEILFP.com.